What if I told you that every major market crash for the last 100 years, 1929, 1987, 2008, and even right now in 2025, was preceded by the exact same 3 trades? 3 moves, 3 decisions, 3 signals that the richest people in the world make, quietly, almost invisibly, right before markets collapse. Moves that don't show up on CNBC. Moves retail investors never even see. Moves that look boring until it's too late. And here's the disturbing part. These trades appear months before the crash. Not after. Not during panic. Before the general public even knows something is wrong. So why do only the top 1% seem to understand this pattern? Why have billionaire investors, Rothschild, Livermore, Buffett, Soros, Dalio, made the same 3 strategic plays before almost every collapse? And why do these 3 trades appear again right now, in 2025? Tonight, we are going to break down the hidden system behind these crisis trades, the psychology that drives them, the financial mechanisms they exploit, and the reason history repeats itself with terrifying accuracy. Stay with me, because once you understand this pattern, you'll never look at the markets the same way again. Every financial collapse looks different on the surface. 1929 was a stock mania. 1987 was a computer-driven sell-off. 2008 was real estate and derivatives. 2025 is being built on sovereign debt, private credit leverage, and AI-driven speculation. Different triggers, different villains, different stories. But beneath the surface, the structure of these crises is almost identical. It starts with a long period of calm. A boom. A time when everyone believes the good times will last forever. In every era, professionals call it something else. New economic era. Productivity miracle. Soft landing. Technology supercycle. But behind the optimism lies the same silent force. Risk builds. Liquidity tightens. Leverage expands. Confidence peaks. And that's when the billionaires start moving. They don't short the market immediately. They don't panic. They don't run to cash first. Instead, they perform the same 3 strategic trades. Trades designed not just to profit, but to survive what's coming. Before we reveal these trades, we need to understand how this pattern formed in the first place. To do that, we go back to the beginning. The year is 1929. Wall Street is unstoppable. Ordinary Americans are opening brokerage accounts for the first time. Everyone is borrowing money to buy stocks. Margin debt is exploding. Newspapers call it the new age of prosperity. Radio hosts swear the market will rise forever. But behind the scenes, the world's first generation of mega investors sees something different. One of them is Jesse Livermore, the legendary trader who understood crowd psychology better than any economist. Months before the crash, he makes 3 moves. Trade number 1, he rotates out of growth into safety assets. Not cash yet. Not gold. Safety assets. Sectors whose earnings stay stable even during recessions. Trade number 2, he buys volatility. Back then it wasn't called volatility. But Livermore purchased instruments that benefit from fear. He didn't know when the crash would come, but he knew fear was cheap, and fear never stays cheap. Trade number 3, he builds a short position in the overleveraged parts of the market. Not everything. Not blindly. He targeted the sectors where leverage was highest and fundamentals weakest. These 3 moves, rotation, volatility, and targeted shorts, made Livermore hundreds of millions during the crash. But more importantly, this became the unofficial billionaire playbook. It would appear again, and again, and again. Fast forward to 1987. Computers are now trading for the first time. Portfolio insurance becomes the hottest new financial product. Every institution is using algorithms to protect their downside, convinced technology eliminated risk. Sound familiar? But billionaire investors like Paul Tudor Jones sense something is wrong. Months before Black Monday, which would become the largest one-day crash in history, 3 unusual signals show up. Hedge fund 13F filings reveal massive rotation into defensive sectors. Healthcare, utilities, consumer staples. Exactly like Livermore 60 years earlier. Options markets show a record spike in volatility demand. Smart money was quietly loading up on VIX-like strategies. Short interest surges in high leverage sectors, especially in the most overvalued technology companies. History repeats. The same pattern emerges. The wealthy prepare. And on October 19th, the market falls 22% in a single day. But the billionaires are protected. Some even profit, because they made the same 3 trades. Now we jump to 2008. The entire world believes housing prices can't fall. Banks say risk is diversified. Politicians say markets are strong. Rating agencies call subprime mortgages safe. But billionaire investors see cracks forming. Michael Burry spots inflated real estate leverage. John Paulson sees the rise in risky mortgage bonds. George Soros sees liquidity drying up. And what do? Trade number 1. They rotate into recession-proof assets. Treasuries, utilities, consumer staples, even certain commodities. Trade number 2. They buy volatility while it's cheap. Burry literally bought the equivalent of volatility by purchasing credit default swaps. Trade number 3. They short the weakest links. Subprime, Lehman's exposure, over-leveraged banks. Once again, the same 3 trades. Because the pattern never changes. Only the narrative does. To understand why billionaires repeat the same playbook every time, you must understand one concept. Markets don't crash because of bad news. Markets crash because of forced selling. When leverage is high, and liquidity is low, and volatility is cheap, the smallest spark becomes an explosion. These 3 trades are designed to exploit the structure of market collapse. Trade number 1. Rotation is protection. It slows losses so billionaires never face margin calls. Trade number 2. Volatility is acceleration. It grows when fear grows. It turns panic into profit. Trade number 3. Shorting the weakest link is leverage. It multiplies gains when the system breaks. Together, these trades create an asymmetric portfolio. Small risk, large potential payoff. That's why the richest people repeat the same pattern. Every time a crash happens, governments promise they'll fix the system. But the fixes create new problems. After 1929 Glass-Steagall, later repealed. After 1987 circuit breakers, markets still fall. After 2008 QE and 0% rates, led to massive asset bubbles. After 2020 trillions in stimulus, led to inflation and record debt. Every solution adds leverage, removes discipline, and increases risk. That's why the billionaire playbook works. It anticipates failure. It anticipates panic. It anticipates human nature. And now, we arrive at 2025, the most important part of this video, because the same signals that appeared before 1929, 1987, and 2008 are appearing again right now. Look at the data. 1. Massive rotation is happening today. Institutions are quietly moving money into a utilities, a healthcare, a treasury ETFs, a cash flow-rich companies, a high dividend sectors. This is rotation. Trade number 1. 2. Billionaires are buying volatility at record levels. VIX options, tail risk funds, crash protection structures. Volatility is cheap right now. Suspiciously cheap. Trade number 2. 3. Short positions are rising in specific sectors. Not the whole market, just like always. Hedge funds are shorting. AI boom companies with no profits. A zombie corporations loaded with private credit. A highly leveraged commercial real estate. A overvalued small cap tech. Trade number 3. The same 3 trades. The same pattern. The same warning. The billionaires are preparing. The question is, are you? Crashes are predictable in structure, not timing. No one can predict the exact day the market collapses, but you can predict the conditions that make a collapse likely. And those conditions appear again in 2025. The richest people don't react to crashes, they prepare for them. They rotate early. They buy insurance when it's cheap. They short excess leverage before it implodes. Preparation always beats prediction. You don't need millions to follow the playbook. These 3 trades aren't secrets. They're strategies available to ordinary investors. A defensive rotation. A volatility exposure. A targeted hedges. You don't need billionaire money. You just need billionaire logic. Every crash in history has followed the same psychological pattern. The same structure. The same cycle of greed, euphoria, leverage, and then collapse. And right now, in 2025, the pattern is repeating. But here's the question. Are we months away from the next big crash? Or are we already inside it? Only time will tell. If you found this breakdown valuable, hit the like button to support the channel, subscribe for more deep dive financial analysis, and comment below. Do you think the 2025 crash has already begun? Your comment helps push this video to more people who need to hear it. Stay safe, stay informed, and I'll see you in the next video.